Good morning, everyone. It is time for what you've been waiting for, and that is go get a cup of coffee, drink a glass of orange juice, make some omelets, whatever you like. Just be here for the polling questions, and we'll get you continuing education credit. And also, if you are lucky enough to be estate taxable or to work for people who are estate taxable, then maybe you'll get something out of today's presentation. My name is Guaymo Baimo, and I am the governor of a puppet government on the island of Ringa Dinga Ringa Binga Linga Winga Dinga 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 Dinga. And if you ever would like to visit me there, just send a postcard in a self-addressed stamped envelope with $5. Thank you very much. And now the presentation will get worse. Okay, good morning, everybody. This is Alan Gassman. I'm a puppeteer and also pose as an estate tax planning lawyer. I am in Clearwater, Florida, not in Boinga Doinga Boinga 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 Boinga. And I'm welcoming you to this amazing, interesting, and I hope not bad presentation on evaluating estate tax techniques, part 2. Now, last week we used the Estate View software to show you basic estate tax planning, and also we went over installment sales and self-canceling installment notes. So I'm not going to spend a lot of time and effort on those techniques today. Today, we're going to talk about some advanced estate tax planning techniques. If you are not fluent in estate tax planning, then you may want to look at last week's presentation first. It is on our YouTube channel. If you just search Alan, A-L-A-N, Gassman, G-A-S-S-M-A-N, YouTube, it will come up and you'll watch the June 3rd presentation. And then when you wake up after you fall asleep, you'll probably know more about estate tax planning than you wanted to know. So what we're going to talk about today primarily is for planning techniques for people who are well over the $12,920,000 estate tax exemption, or perhaps will be well over about $7 million when the exemption, as it increases for chained CPI, is scheduled to go down in 2026 to 1/2 of its present level. So we want to talk today about some of these estate tax planning techniques, and I'm very excited to be able to use our Estate View software program, which I will open up here. I think I should be able to open up here. There it is, which you'll be able to use as much as you want for free until it's finished, which isn't anytime soon. So you can be a beta tester. So anyway, next week, oh, by the way, if you want to ask a question, you can just, where did I go on the questions? You can just click on the inverted pyramid, say the word King Tut 3 times, your computer will open to the question panel, and then you can type in your question. If I know the answer, I will answer it. If I don't know the answer, I will pretend not to see it. You can also email me at Alan, you see it there, A-L-A-N, at gassmanpa.com. So next week, I'll be talking about part 3 of this 3-part series on estate tax planning. And then at noon, I will have Chuck Dallenbach, who is the most accomplished trombone, one of the most accomplished musicians on the planet. He leads the Canadian Brass and is a very, very interesting guy, as well as having a PhD in music and being the most prolific player of the tuba of all time. He's played tuba in more concerts and more recordings than anyone else, including Tubby Tuba, who was one of my favorite cartoon characters. And then July 1st, I'll be talking about protecting your business and your family as far as general estate planning, creditor protection, and estate tax planning. Now, the question that we'll be answering next week is what somebody with $60 million can do with $10 million. If they only want to plan with $10 million, what can they do with an installment sale? What can they do with a skin? Can they do with a grantor retained annuity trust? So that's what we'll be covering next week. This week, and here we are with the Estate View software. If you want to use this, just send me an email, put the word beta, B-E-T-A, in the email, and I will send you the email address to use. It's a top secret email address. It is test, T-E-S-T, at test, T-E-S-T.com. And then there's a top secret password, which is the word test. Nothing has to be capitalized, just like I'm not capitalizing yet on this software. And then you can use this to your heart's content. The main module, which many of you have seen, has changed just a little bit here and there. At the top here, if you want to go to something specific, such as loading the insurance information, you can click on insurance and it takes you right there. And in the insurance mode now, if you want to put the life insurance information in there, you can either click red and the life insurance will go away. And a lot of people would like your life insurance to go away. Or if you want to add a life insurance policy, you hit the plus sign, and then you can put the information about that policy, the number of years premiums, the amount of the premiums, the death benefit, and whether it's in a life insurance trust or not. And then if you want to duplicate that policy and show before and after, like before, you have this, but after, you modify it so that it is in a life insurance trust, then you'll click the copy and you'll click the life held in ILIT, and that's how it will work. Okay, so last week we covered the installment sale and the self-canceling installment note. So just to remind you, with a self-canceling installment note, if I'm of reasonable health or possibly not so reasonable health, but the IRS argues about that, then I can sell assets to a trust for the benefit of my descendants, and that trust can be disregarded for income tax purposes, and on my death, that note can vanish and not be subject to federal estate tax. So let's say that I'm 64 years old, which happens to be the case, and I do a single person self-canceling installment note. So this is a new feature. If I have no second life, in other words, I'm not married, or my wife's not involved with the note, I put 0, and you see I have a 19.8 year life expectancy. That means that half of the people today, age 64, will be living in 19.8 years, and half of us will no longer be living. And then I can safely make the term of the note 19 years. If I make it more than 19 years, then the IRS will consider the note to be a private annuity, and then the income and estate tax consequences of the private annuity world would apply, including the exhaustion test. So most of us make our notes for 19 years. And then my computer has told me that my lowest applicable federal rate for a 19-year note, if I did a regular note, would be 3.69 years. And then to make this an arm's length transaction so that giving this note Giving assets to a trust for my children in exchange for this note is not a gift. I have to gross up either the principal or the interest rate. And if I elect, that's what this premium type is. So if I gross up the interest, I see here that the interest premium is going to be 3.0558% based on the actuarial tables and the 75/20 rate of 4.2%. So my interest rate has to be 6.75%. So I go to the doctor and the doctor says, Alan, I've got good news, I've got bad news. I say, what's the bad news? He says, you have a terminal disease, you only have 5 years to live. And I say, what's the good news? And the doctor says, I saw your video on YouTube. You can do a self-canceling installment note. You could sell $10 million worth of assets to a note for your descendants, and the note could bear interest at 6.7458%. And if I'm right, and you die before the night, and you die even in year 19, then the estate tax savings will be $406,000. But if I die sooner than that, the estate tax savings will be colossal. If I die in the 5th year, I can see here that the interest I would have paid would have only been $3 million, and $7 million, and $10 million is forgiven. So it's a great thing. Now, the IRS says I have to be of reasonable health, but that's not clear in the case law. If I want to be more clear in the case law, I can use a private annuity that I'll show you in a little while. But if I'm going to be a daredevil and I'm going to go on a 5-year plan that I think I really don't have more than 5 years to live, what if I make the term of the note from 19 to 10 years? Watch the interest rate premium here. As I scroll down the term, the interest rates go down. So if I do a 9-year self-canceling installment note, the interest rate is only 5.89%. Because what's the worst thing that could happen? The worst thing that could happen is that I live a long time. They invent a cure for this 5-year disease, and as a result of that, my trust has paid me back more interest than I would have otherwise received. But you know what? It gets better than this, because I could put my $10 million worth of assets into a LLC, and then I could sell a 99% LLC interest to this trust. And how much would the note have to be? Well, if I could discount the 99% non-voting LLC interest by 20%, then you see that the note is only $8 million. So now, although there's really $10 million worth that I've transferred away, or at least $9,999,000, with growth at 7%, minus a payment of $471,000 a year on an 8-year note, I'm going to have plenty left in this trust by the time that I would pass away, and then the note would go away. So that is the self-canceling installment note that we discussed last week, and this is basically how to use it. Now, what's changed is this week, Kevin went ahead and allowed me to do a dual life note. So watch this. I'm 64. Let's just say that Marcia's 59, which is a perpetual condition. So right now, if I do the note on myself, it's 5.89% for a 9-year note. But with Marcia at age 59, I could do a dual life note. She's at age 59, and I click that in, and the rate goes down to 4.34%. And then our joint life expectancy is about 23 years. So I could go with a 23-year note. and I could hit a full fit here, and you can see what the situation is, and you can illustrate it. And then for those of you who are new to Estate View, I can also click Export to Excel, and then it has created an Excel spreadsheet with the numbers in it, so then you can massage them as you like. All right, so that's a refresher on what we did last week. Now I want to go to the alternative to the self-canceling installment note, and that is the private annuity. So you see private annuity there. I went to the calculator, I click on private annuity, but wait, before I do that, we have to pause for a paid advertisement, also known as a polling question. So we'll start with polling question number 3 for some reason at page 40. And that is, would you like to subscribe to our mediocre presentation, which used to go out every Thursday and now goes out at least one Thursday a month, called, believe it or not, the Thursday Report? And the answers are either yes, I do, B, I already do, or C, I would rather have a spinal tap. Josh, let me know when we have the answers in, and we can go ahead and come back to this exciting webinar. Okay, so with a private annuity, I can sell $1 million worth of assets for my life expectancy in exchange for an annual payment. So I'm going to go back down here, and I am age 64. That's what Paul McCartney wrote that song for me. The program knows that I'm using table 2010, which is the 2010 life expectancy table. The computer knows that I'm at the 75/20 rate of 4.2%, which happens to be 120% of the midterm applicable federal rate, and that I would like to see a level private annuity, and that the assets I sell in exchange for the private annuity will grow at 7%. So what do I do here? I've got $1 million, 75/20 rate, 4.2%, and the annuity amount that's going to be paid to me is $79,767.72 a year. I mean, $72 a year for the rest of my life. So let's make it more exciting and go up to 10 million on the value. So I sell 10 million worth of assets to this trust for $797,677 a year. And if I die before receiving the first payment, then the trust has 10 million, and it is free of estate tax because I never got a payment. So you go to the doctor, and the diagnosis is you have something, and your life expectancy to die from this particular disease that you have is 2 years. But because you have 2 other diseases, your life expectancy is 1 year. Well, the Treasury regulations, if you read them, say that if you have better than a 50% chance of not dying from any particular condition for a year, then you can use the private annuity. So let's say I have 3 conditions. I've got a heart condition, a diabetes condition, and COPD. None of them are expected separately to kill me within a year, but I'm expected to live no more than 8 months. I can still do the private annuity. And what if I am going to actually live 1.5 years. So I do the private annuity and I live 1 year, 1.5 years, and I die right after 1.5 years, then I am presumed to have been healthy enough to enter into it, unless the IRS presents clear and convincing evidence that I did not have a year to live. So this private annuity is very, very powerful. The reason that we don't use the private annuity as often as the self-canceling installment note is that most of the time you want to make the sale to an irrevocable trust so that it's income tax free. And the IRS regulations have what is called an exhaustion test. And it's exhausting to read them. But the exhaustion test says that you have to have enough assets in the trust that you sell to fund the payment as if you were going to live until age 110. Even though there's less than a 1 in 1/10,000th chance that a 64-year-old will live to 110. So we're not sure if those regulations are effective or not, but we do have to pay attention to them. Now, with the private annuity, I could also do a second life private annuity. So if I were to say, and this happens sometimes, the client says, you know, we want to give it all away. We don't want to pay any estate tax, but we don't want to run out of assets either. And we spend a certain amount a year. So you say, well, how much do you spend? Well, I spend $500,000 a year. Together, we spend $500 a year. We always want to be able to get $500 a year. Well, okay. You're 64 and your spouse is 62. So we'll put in a 62-year-old. This will now be a joint and survivor annuity. So on 10 million, the annuity amount would need to be $655,000 a year. Well, you only need $500,000 a year. So let's flip this down to 500. And this, you would feel comfortable selling $8 million worth of assets for $5 million a year. Now, you could also, by the way, I'm showing a level annual annuity payment. In many cases, we use a payment that increases every year. So if I use a payment that increases by 20% a year, for example, the initial annuity amount on this $8 million gift is only going to be $20,000, but then it ramps up over the years, as you can see. So that would be another way to do this if we don't need the money right away. In the kite case, K-I-T-E, and you can watch a musical video on kite if you search Gassman Kite, K-I-T-E, YouTube. Mrs. Kite did a private annuity. She had a not good health situation. She did a private annuity where there were no payments the first 10 years, and she died during the first 10 years, and there was no estate tax. And the tax court said that that was okay. So that was a good fit for her, more aggressive than what most of us do, but the tax court let her do it. Now, what if I want to use discounting as well? I will go to advanced here, and in advanced, and let's go back to a level payment because the client wants to get $500,000 a year, and let's assume a discount of 25%. Well, now my real value, or my discounted value is 6%. My annuity amount is lower than what the client wants. So I can click up to where we hit about 500,000. So I could put 10,500,000 into an LLC. assuming a 25% discount. So what I'm basing my life annuity on is $7,875,000, and the annual annuity payment $516,000, payable until the death of the survivor of Marcia and I. And at that time, everything in the trust belongs to our descendants. And if you take that to age 9, my age 91, her age 89, then the descendants are going to get $28 million at the end of it all, estate tax free. Not a bad deal, but there had to be a lot of assets in that trust in order for it to have been to qualify for the exhaustion test, which I would be exhausted if I explained it to you. And hopefully next week I'll be able to show you the exhaustion test working on this software. So we've covered the self-canceling installment note, we've covered the private annuity, and now we're going to do, yes, you guessed it, another polling question. Let me find polling question number 2. Slide 20. Are you involved in estate planning as A, an advisor, B, doing your own planning, C, all of the above, or D, sorry, I signed on to the wrong webinar entirely? Or you could do E, I really needed the credit and there was nothing else happening on Saturday at CPA Academy, which I guess is probably what half of you are going to say. If you're awake, please wake up your boss if you're a cat. No. That wasn't a real cat, but he's from Connecticut. So that is polling question number 2. I put them in consecutive order just to mix you up. Okay. Polling question number 1 coming up in about 15 minutes. All right, we'll go now to something similar to an installment sale, and it is called a grantor retained annuity trust. So with a grantor retained annuity trust, believe it or not, I form a trust. And that trust says that it will pay me an annuity amount once a year for a term of years. And then everything remaining in that trust after the term of years escapes federal estate tax and can be held for my spouse, for my descendants, for my cousins, whoever I want. It's called a grantor retained annuity trust, and it is specifically permitted under Internal Revenue Code section 2702 and the regulations under section 2702. And it has something very, very nice that an installment sale doesn't have. And that is a formula provision is permitted. So in an example here, I put $1 million into a grantor retained annuity trust, and it says that it will pay me 10 payments, 10 equal payments over 10 years of $124,522 a year and 12 cents. And after the 10 years, whatever is left in the GRAT will pass estate tax free. And basically that means that if the assets grow by more than 4.2% a year on average, there will be something remaining in the GRAT. Now, what is the value of the gift that I make when I transfer $1 million in cash, real estate, or cats from Connecticut into a grantor retained annuity trust that pays me $124,522.15 a year for 10 years? And the answer is 0. In fact, the annuity payment right is worth $5.01 more than the value of what I'm putting into the GRAT. So this is I don't have to make a 10% seed capital gift like I normally would do for a self-canceling installment note. And I don't have to worry about paying a gift tax if my valuation that I'm using comes out a little bit high. With a self-canceling installment note, I think I'm selling $10 million of cats in Connecticut. Turns out they're worth $12 million. I've made a $2 million gift. I can have a adjustment clause or what we call a Wandry savings clause. It may or may not work. The IRS doesn't like them. But the IRS is pretty much stuck with the fact that if I put $1.2 million worth of cats into this GRAT and they audit it and I acted in good faith, because I relied upon a reasonable valuation expert, then what happens is instead of having to pay $124,000 a year back out, it'll be higher. If it's $1.2 million, I can just click here, or let's say that turns out the cats were worth $1.5 million, then I should have paid $186,000 a year, and I'll just pay the difference. Okay, and then you see that in the 10th year, because I start with year 0, in the 10th year, there's $246,000 left in the GRAT. I've used none of my gift tax exemption. I've gotten $246,000 out of my estate. But let's make it better. So we go to advanced, and let's say that I'm 60 and I'm going to die at age 89 or 79, 19 years. So I better have some serious fun. So after 10 years, the value is $246,000. But when it grows at 7% for the rest of my life, it's really $485,000 that avoids federal estate tax. So the estate tax savings there is $194,000. But let's make it better. Let's say that I have a company. Well, actually, let's say I don't have a company. We'll just make it better by using a discount. So let's say I put in, let's say that I put in 10 million to make it a little bit more exciting. It's 10 times more exciting. And I use a limited liability company. I put $10 million worth of cats into this limited liability company. And by the way, for this to work, the cats cannot visit me, which for some of you, that's what you like. You don't like cats. So if you're going to put cats in a GRAT, and hopefully they'll grow at 7% in value, then they can't visit you because of Section 2036. They might be able to visit you during the first 10 years, and every year, if you don't have cash, you would have to give cats out. So you'd have to value the cats every year. But if I put $10 million worth of stock into an LLC, and I transfer the 99% non-voting member interest in the LLC to the GRAT, and I take, let's say, a 20% discount, then the GRAT payments are going to be based on an $8 million contribution. And my annual payments are going to be $996,000 a year. And what's left after the 10th year is $5.9 million. And on my death in year 21, $13 million has escaped estate tax saving $5 million. Let me just massage these numbers a little bit. So first of all, there's two kinds of GRATs, basically. You can take annual equal payments, or you can have the payments go up by 20% a year. So you see the remainder interest of $13 million. If I take equal annual payments of $996, let's increase by 20% a year. my initial annuity payment amount is 407. It builds up to 2,100,000. Now my remainder interest is 14 million. So instead of 13 million using a 20% per year increase, I've got 14 million. And by the estate tax savings are more. Okay. Then my target gift value. I'm showing here a zeroed out GRAT where the gift value is 0. A lot of experts, including Jonathan Blattmacher, say you need to have some gift value at the beginning and file a gift tax return, tell the IRS what you're doing so they only have 3 years to challenge this. So I could say that my initial gift would be $10,000, and therefore my annuity amount is adjusted a little bit, estate tax savings adjusted a little bit, or I could say I want my initial gift to be 1% of the value of the GRAT, and that will, at 1.03%, that will change that a little bit. So now, maybe instead of putting in a company that grows at 7% a year, I have a company that grows at 5% a year, but it shoots off $100,000 a year of income. And I would like to do a GRAT that would allow the GRAT to just pay me the $100,000 of income as my annual annuity payment. So let's say that that company happens to be worth, oops, I went backwards. Don't go backwards, stop that. If the company, what do I need to do for the annual annuity payment to be $100,000 a year? Okay. If the company is worth $3 million, and sorry, the company, awkwardness. All right, the company is worth $2.5 million. It's growing at 5% interest. It pays a dividend of $100,000 a year. I take a 20% discount. I put that $2,500,000 company, 99% of it non-voting, in the GRAT. The GRAT pays me $100,000 a year the first year, but then increases every year thereafter. If the company can support that cash flow, then I've gotten the whole GRAT out of my estate. But if I'm using level payments, then the annuity amount would have to be $246,000 a year. So if you have a company and you want to do a GRAT, you can go ahead and gear the number of payments to what can be to the number of years GRAT payment. So to get down to $100,000 a year in equal payments, I would have to do a 42-year GRAT. Well, that's not going to work. So, but if the company is worth much less, then it can work very well. I probably confused you and should not have done this program the day after anesthesia, but here we go. So that is the grantor retained annuity trust. By the way, if I want to do a second GRAT and compare it to the first, I can hit add GRAT, and it then allows me to do a second GRAT, and then I can compare the two GRATs. So there you go with the grantor retained annuity trust as an alternative to the installment sale. Now, something very similar to the grantor retained annuity trust is the charitable lead annuity trust. So this is where Professor Miller said, when I graduated from the when I got into the tax program at the University of Florida in 1983, Professor Miller said the estate tax is a voluntary tax. People only pay it if they don't plan for it. Well, in all honesty, if you're at $500 million or more and you don't get some sort of awful terminal disease, I probably can't zero out your estate tax, but I can certainly reduce it. And most of the estate tax that an 80-year-old billionaire pays will have been voluntary by reason of not planning. But as the last resort and the best resort, you could die and leave it all to charity. And then there would be no estate tax. And you could leave it to a private foundation to be formed on your death or before your death, to be operated by your children, grandchildren, great-grandchildren, and they can receive reasonable compensation for certain services that they provide to that entity. So that is one charitable alternative that he told us about. The second charitable alternative that he told us about is the charitable lead annuity trust. And it works based on the sections 2702 statute and regulations in the same way as a GRAT. So what this is telling me here is that I could put $1 million into a charitable lead annuity trust that would pay my favorite charity, which would be maybe the Gassman Foundation, $124,522 a year for 10 years. And what's left in the CLAT after the 10th year goes to my spouse and descendants. It can be in a bypass trust for Marcia and then pass for our descendants. So you may say, well, that's not such a great ratio. You have to pay $1,245,000 a year to charity, and then at the end of 10 years, your kids, your spouse, only get $246,000. Well, it's better than nothing, but this assumes a 7% rate of return and level payments. I can go with increasing the payments by 20% a year, and when I do that, the remainder interest is $312. You see the payments start small and get bigger. Or I can do what's called a shark fin CLAT. Now, you can't do this with a GRAT, and the IRS may not like it so much, but with a shark fin CLAT, the payments are like a shark fin. See? See, we had live graphics here. You got to give me a hand. Hello there, everyone's hand. Okay. So I go to shark fin, and that works well with the cats, because sharks and cats, oh, never mind. I know I'm going to have a bunch of email from cat lovers and shark lovers. But anyway, I do a shark fin CLAT, where the CLAT pays $5,000 a year for 9 years, and then in the 10th year, charity gets $1,453,000, and my descendants get $449,000 estate tax free. So instead of paying instead of paying $400,000 in estate tax on my death, if I have no spouse, they instead get $449,000 after 10 years, which is not so bad. But what if I go with a discount vehicle? So I go to, well, first of all, before that, what if I go with a longer term? If I go with a 15-year term, then they get $992,000, charity gets $1,008,000. If I go with a 20-year term, they get $1,707,000, charity gets $2,214,000. But what if I die leaving a 1% voting member interest in a gift in $1 million LLC to a trust for my grandchildren, and I leave a 99% non-voting member interest into the CLAT. So here, I will take a conservative 20% discount, and now the charity gets $1,739,000, and my descendants get $2,181,000. So that's not much different than 60-40. A lot went to charity. My descendants are going to have to help charity out, whether they want to or not. In fact, I have a few estate plans where the client has required that before the beneficiary who has reached age 21 can get any benefit whatsoever, they have to spend at least 10 hours a month doing strictly charitable causes. And I don't mean sitting in the boardroom, I mean serving the soup or helping with the garden, one-on-one. Now, if I go with a more conventional 20% per year increase, still at the end of the day, the charity has received a significant amount, but the descendants have received $2 million. So that is the charitable lead annuity trust. And it is time for our next polling question, which is polling question number 1, just to confuse the accountants. The non-accountants are not at all confused by the order of the questions because they don't keep track of this stuff anyway. But would you like to beta test, be a free user for a while of our Estate View software? A, yes. B, I don't like to fish. C, no, but I do like to fish. D, no, I would rather buy another set of encyclopedias. So, Josh, let me know when we've answered that so we can go back to this exciting presentation. Okay, all done? Good. All right, for those of you who are CPAs and enrolled agents, Josh is going to remind me in about 10 minutes to do the last polling question, but I think if you already answered 3, you've got enough, but I will do the next one in about 10 minutes. All right, so the final calculator that I'm going to show you, and I'll do it again next week, is the Qualified Personal Residence Trust. So this one is also, I think, very interesting and very advantageous, and people don't do enough of them because they don't understand them. I have a home, and let's say it's worth $1 million, and it is growing in value, of course. It's growing in value at, let's find the growth rate, at 4.5%. One thing I will mention to you is the average house does not grow as well as a stock and bond portfolio. A lot of people think their houses are growing well, but when you take into account what it costs and the fact that your house is a year older every year, a 4% growth rate is probably good over the last 50 years. And we'll be comparing this to an installment sale next week so you can see if it's worth doing. But in any event, I've got $1 million home, it's growing at 4% a year, and I am age 64. So if I were to do a 10-year Cooper, I would put the home in the trust. The trust is for Marcia and our descendants, and I have the right to use the home for 10 years. The fact that I have the right to use the home for 10 years allows us to take a discount on the amount of the gift, which you can't do in any other context than the GRAT, the CLAT, and the Cooper. These are statutory animals. Meow. So the amount of the gift I've made, even though I'm getting $1 million home out of my estate, the amount of the gift is $531,000 based upon a 64-year-old doing this for 10 years. And I have an 80% chance of living for 10 years according to the actuarial tables. Now, if I went to 12 years, then I have a 74% chance of living that long, and my gift is down to $454,000. So then you see here the value of the home growing at 4% a year, and then you see that after the 10th year, I don't want to be kicked out of the home. I'll pay rent. And I'll pay rent, let's say, based at 6% of the value of the home each year. So when you look at that, and I live until age 90, there is $4,800,000 of assets that were moved out of my estate when you count the home and the rent that can benefit Marcia for her lifetime health education and maintenance. She can have a power of appointment to direct where it goes when she dies. And if she doesn't exercise the power of appointment, it can go automatically to our children. Now, I think I should be using the 2010 table, so that changes the numbers just a little bit. So that is a simple Cupert. Now, what if Marcia does a Cupert and I do a Cupert? What would happen? Well, I would take the home, and what I could do is I could sell half of the home to Marcia for $500,000. So she gives me $500,000, I give her half the home. So now I have half the home at $500,000. I put half the home into a Cupert, and now I am going to be able to take a discount because, well, actually, I can just go up here, keep the home at $1 million, but I'm only giving half the home away. So I can say here, percentage of home given, ownership interest given, 50%, and I can take I will take a 15% discount because half of a home is not worth 50% of a home. Who would want to buy half of a home? But on the other hand, you do have state partition rights. If you own half a home, you can force a sale of the home. So that's why I would take a discount. And as a result of that, I am using less of my gift tax exemption. I'm only making a $204,000 gift. And then Marcia can do the same thing, only making a $204,000 gift. Now, under the reciprocal trust doctrine, I should not have the ability to have a benefit under the Cupert that Marcia sets up if Marcia's going to have a benefit under the Cupert I set up, in our opinion. You might be able to do what's called non-reciprocal slats, but I don't believe that they're as safe as a lot of people do. So that's a quick summary of a qualified personal residence trust. Now, we were assuming that you would pay rent for the rest of your life. You know, you may sell the house and put it in different investments, so we might therefore take out the rent. Another thing we have here is some charts. If you go to the charts, you can see blue is the value that passes estate tax-free, red is the value of the gift, and then here's the chance of surviving the term. And as you click up the number of years of the term, you have better tax savings on the left, but a bigger risk of death on the right. You may buy term insurance to handle that risk of death. there's a lot more to show you, but I think that that's probably enough for now. Let's do the last polling question. I'll answer some questions that came in, and we'll call it a day. Next week, we will be comparing these various techniques in various ways, and we'll get a little bit more into the Cupert. By the way, there is now a 2-life Cupert. So I can show you here that Marcia, who is 59 perennially, we could do a joint life Cupert, 19 years. And if we did a joint life Cupert for 19 years, the gift would only be 168,000 of each of the $1 million home. So very interesting stuff, and we'll go over it more next time. So let me go to Josh, where is the 4th polling question? Page 50. Okay, would you like a PDF copy of our book, 8 Steps to a Proper Florida Estate Plan? Yes or no? And do you think we should have capitalized the word steps to a proper Florida estate plan? Yes or no? The answer is the same for both questions. You have 10 seconds to answer this, or your computer will start smoking. And I won't tell you what it'll start smoking. All right, I'll stop sharing the screen here. I don't like sharing anyway. At least that's what I remember from kindergarten. All right, we have a lot of questions here. You've done all the polling questions. If you leave now, no one will know. CPA Academy will be plenty happy. And let me just go over some of these questions. Okay, John Lugo, who is the winner of the most questions and comments of all time award. Thank you very much for all of your pointers. Your question is, what about the income tax? Yes, I have not covered income tax very much today, but everything I've shown you is income tax neutral. Everything I've shown you, the GRAT does not pay tax. The grantor pays the tax on the GRAT income during the lifetime of the GRAT and thereafter. The CLAT can also be either disregarded, or if you do it during your lifetime, you can get a charitable deduction when you fund the GRAT, but then the grantor has to pay the income tax on the income of the GRAT during the term that it goes to charity, and there's others issues concerned there. The qualified personal residence trust, you can draft it so that you still get the tax deduction for the interest paid on the mortgage, and also for the property taxes. You can ignore the mortgage if the grantor of the Cupert agrees to make all of the payments. So thanks very much for that question. The GRAT, the probability the grantor survives, 7.4. Sorry, I got lost there. Baby shark, doot, 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 doot. Baby shark, doot, 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 doot. Thanks, Diane, for that comment. This webinar is the second of a 3 series. I wonder if the presentation will be archived, and if so, how. You can go to Alan Gassman and YouTube, just search Alan Gassman YouTube, it comes up and you'll see this whether you want to or not. It will also be archived on the CPA Academy if you go to cpaacademy.com. By the way, if you're not a CPA or enrolled agent, you can still join cpaacademy.com and see a lot of really good free webinars, although none of them will be as good as this one. Okay. Did you say Cupert? Often video, great game. QBRT, haven't played it, but Cupert, Qualified Personal Residence Trust. Okay. Can someone let the presenter know that we cannot? I'm sorry that you were not able to, Carol. I don't know what happened. I was talking. Hello from Florence, South Carolina. I bet you wish you were in Florence, Italy, although they probably have good Italian food in Florence, South Carolina also. Okay? Is there any distinction between the first and second life if both, for example, are 72, but the second life is the wife who will put her husband in the ground before her? I'll add the word happily or unhappily. No, the actuarial tables are neutered. So everybody, they don't take into account male or female. So it's interesting, isn't it, that I can sit with the client and say, how healthy are you? What's your life expectancy? Well, I'm perfectly healthy, and my grandparents and parents all lived until they were 101. Well, good. I could do a longer Q-tip, or I mean a longer Q-pert on that. Okay. Can the GRAT annuity payout be quarterly, Nancy? Yes, it absolutely can. Let's see. John points out that you can file a gift tax return and request an early audit so that you're out of this thing in a shorter period of time than 3 years. I'm not sure that's the case with a gift tax return. I think that's the case with an estate tax return. Okay. Nancy, can I compare a CLAT to a CRUT? Yeah, a CLAT is C-L-A-T and a CRUT is C-R-U-T. So the two middle letters are different. But I will next week compare a CLAT where the annual payments go to charity. What's left goes to the family. With a CRUT, where the annual payments go to the charity and what's left go to the family. So with a CLAT, you set the payments high so that the interest going to the family is very low, if not zero, under the gift tax rule. With the charitable remainder unitrust, you have income tax savings. So you typically make the unitrust payment as high as you can and what goes to charity as low as you can. And the charity has to get a remainder interest actuarially calculated to be at least 10% upon inception. So we will do eventually an entire program on comparing CRUTs to CLATs. Thank you very much for pointing that out. Somebody else said Baby Shark do 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 do, which my granddaughter Ava really likes that song quite a bit, but also she likes Yellow Submarine. Okay, Gazella, when can we get the Florida estate plan? I guess when you move to Florida. All right. And then finally, is there an IRS ruling or private letter ruling that lets the grantor continue to pay the mortgage and not have each payment be a gift on the Q-pert? That is a private letter ruling. And I'll go ahead and reference that for you specifically next week. But Stuart, the authorities think that that's safe. I believe it's safe. Would the best practice be to pay off the mortgage before you do the Q-pert? That would certainly be simpler, but I don't know that you have to do that. And then Mike has a great question, and we're going to handle this. The law clerk's going to do this next week. Is there a glossary for all these acronyms and a brief summary for each one? That's what you're getting next week. Thanks for thinking of that, Mike. All right, everybody, I hope you enjoyed today, or at least you pretended to. Thank you very much for attending. I did have a minor surgery yesterday, so I'm blaming my confusedness on anesthesia, but it was fun anyway. Have a great, great rest of your day. And if you enjoyed this half as much as I did, then I enjoyed it twice as much as you did. And if you've never heard that joke before, you need to start watching Monty Python more and me less. Thank you.